Hello, I'm Dr. Cheryl Dunn, and I'm here to demonstrate a problem for a fictitious company called Hawkeye Lakers, Inc. And in this problem, we're going to look at inventory costing with perpetual inventory, and we're going to use the first in, first out perpetual method, the last in, first out perpetual method, and the weighted average costing perpetual method. Take a look at the problem. Pause the video for as long as you need to read it. Okay, as you can see, I've divided my board up into 3 sections, one for each method. And so in this method, we'll do the FIFO perpetual. And at the top here, I'm going to start with making a graphic that will maybe help us a little bit to keep track of the different inventory that we're going to be dealing with. So I'm going to start us with a layer. And this layer is going to have our beginning balance of inventory in it. So this is the 4-1 balance. And we can see that we have 400 units that each cost $90. With the perpetual inventory method, we must evaluate the cost of goods sold and the ending inventory as each sale is made. And so our first sale is made on April the 6th. And on that day, we sold 300 units. And because this was the only layer we had at that point in time, they must have all come from that layer. And so we would say that the cost of goods sold is going to be 300 times 90. And that's $27,000. We'll further say that then at that point, we would only have 100 units left in ending inventory. And so that had a value at that point of $9,000. Next on April the 9th, and I probably shouldn't have written this out here, so let me kind of move this back inside here. So we're only at 100 now. Then on April the 9th, we bought another layer of inventory. And in this layer, we bought 600 units that each cost $100. Then on April the 11th, we had another sale. And so on that sale date, we're going to evaluate the cost of goods sold and the ending inventory. And so we sold 250 units. And under the first in, first out method, we would assume that we sold the bottom layer first. And so our cost of goods sold is going to consist of 100 units that cost us $90 and another 150 units that cost us $100. So 100 times 90 is 9,000, and 150 times 100 is 15,000. So we would say that the cost of goods sold for this sale is $24,000. Then we had another sale on April the 14th, and I should update our graphic here. At this point, we don't have anything left in the bottom layer. And in this next layer, we now only have 450. And so before I wrote in this sale, I should have put in the ending inventory up here. That is 450 units that each cost $100 for a total of $45,000. Now on the 14th, we make this sale, and we're selling 400 units. And the 400 units can only have come from that layer. And so we say that the cost of goods sold is 400 at 100, for a total of $40,000. The ending inventory then there are 50 units left at a cost of $100 each for a total of $5,000. Then we buy some more on April 15th. So I should update this so that we no longer have 450. Instead, we just have 50 of these left. So we have 0 of these, we have 50 of these. And then on April 15th, we buy some more. So this is on 4/15, and we're buying 200 units that each cost $105. And then we immediately bought some more, well, 3 days later, but before we made any sales. So on the 18th, we bought another 700 units that each cost $95. And then we got to April 21st, and we made another sale. And we sold 800 units. In this case, our cost of goods sold is going to consist of the first ones in were the first ones out. So we're going to have 50 of the units that cost us $100 plus 200 of the units that cost us $105 plus 800 minus 250 is going to give us $550. So $550 of the ones that cost us $95. If we multiply that across, we get 5,000. 200 at 105 is going to give us 21,000. And 550 at 95 is going to give us 52,250 for a total of $78,250. Our ending inventory at that point, we would have gotten rid of those 50, we would have gotten rid of those 200, and we would have gotten rid of 550 of those, so we would have 150 of those left. And so our ending inventory at that point is 150 units that cost $95, which gives us a total of $14,250. Okay, so we've almost answered all of the questions that they asked us for this problem. We just have to do some adding up, right, to get the total cost of goods sold for the month. We do have the ending inventory. This is the ending inventory at the end of April, assuming we have all of the information that we're working with. But we need to add together the cost of goods sold from the individual sales to get the total cost of goods sold. Inventory is kind of a running balance thing, so it's up to date as is because it's a balance sheet number. The income statement number has to encompass all the activity that occurred during that month. So we need to add together the 27,000 here with the 24,000 here with the 40,000 here and with the 78,250 here. And so if we sum the cost of goods sold, that's going to give us a total of $169,250. Then it asks for the gross profit, and so first we have to calculate the sales. In the total sales, we had 300 units plus 250 units plus 400 units, so far that's 950. And then we had 800 units there, so we had 1,750 units that each were sold for $170. And if we multiply that across, that's going to give us $297,500 as our total sales. We then take sales minus cost of goods sold to get gross profit, So 297,500 minus 169,250 is 128,250 gross profit. So there we have our answers for the FIFO perpetual method. Next we're going to use the LIFO perpetual method. And again, we'll start with a graphic at the top. And the difference between the FIFO perpetual and the LIFO perpetual is that in the FIFO we sold from the bottom of the pile. In the LIFO we're going to sell from the top of the pile, because we say the last in is the first out. So we put it on and then we take it off the top. So we're going to again start with the April 1st balance of 400 units that each cost 90. And we again have to calculate cost of goods sold and ending inventory each time a sale is made. So on April 6th again, when we sell 300 units, our cost of goods sold had to come from that bottom layer because that's the only layer we had at that point. And so we take 300 units at 90 to get 27,000. And the ending inventory is the 100 units that we still have left at 90 for a total of 9,000. So that's the same under both of these methods because it was the only inventory available. And so at that point we would cross out the 400 and replace it with 100. Then we buy another layer of inventory. And so this is our April 9th added layer, and it happens to be 600 units that each cost $100. And then we get to April 11th and we make another sale. This sale is for 250 units. And with this last in, first out method, we're going to assume that those 250 units came from that top layer. And so we're going to take those 250 all at a cost of 100 each, and that's going to give us cost of goods sold of 25,000. So we take 250 away from there. 600 minus 250 is going to equal 350. So we've got 350 left at that point. Plus we still have the 100 that cost us 90 each. And so we're going to have our ending inventory is going to consist of the 100 at 90, which is 9,000, plus the 350 at 100 each for a total of 35,000. And we add those together to get total ending inventory at that point of 44,000. Then we make another sale on April 14th. This sale was for 400 units. And for the cost of goods sold, we're going to again start with the top layer. And so we're going to assume that 350 of these units were that top layer that cost us 100 for the total of 35,000. And then the other 50 that we sold were from the bottom layer that had each cost us 90 for a total of 4,500, giving us total cost of goods sold of 39,500. The ending inventory then is going to consist of, those will be gone, this will be down to 50. And so that's the 50 that we have left. 50 that cost us 90 for a total of 4,500. Then we buy some more, and so we add an April 15th layer here, and that is 200. That cost us 105. And then we get to April 18th and we get another layer, and this layer is 700 units. That cost us 95. Then we get to another sale on April the 21st. We sold 800 units. And for our cost of goods sold, we're going to sell from the top, and so we're going to say that we had 700 that cost us 95. That's 66,500. And the other 100 that we sold were from the next layer down at 105. And so that would be 10,500, giving us a total cost of goods sold of 77,000. The ending inventory at that point, we would say this layer is gone, and we now only have 100 of that layer. And so we would say that we have 100 that cost 105 for a total of 10,500. Plus we still have that original 50 that cost us 90 for 4,500. Therefore we have total ending inventory of 15,000. So this 15,000 is the answer to the question of what is the ending inventory at the end of April. To get the cost of goods sold for the month of April, we have to add up each of those individual amounts. So we've got 27,000 plus 25,000 plus 39,500 plus 77,000. And so if we add those together, we get 168,550. Our sales is still the same as it was under the first method. So the 297,500 minus the cost of goods sold, which under this method is 168,550. That would then leave us with gross profit of 128,950. The third method we were asked to use is the weighted average unit costing. When we're using this in a perpetual system, sometimes it's called a moving average method, but we'll stick with the term weighted average costing. With the weighted average perpetual method, we need to calculate cost of goods sold and ending inventory after each sale is made, and we need to recalculate the average cost after each purchase is made. And so it's going to act a little bit differently from the other two methods, where we don't really have, the graphic isn't going to do us much good in this method. So when we make our April 6th sale, we're going to look at what average cost those units had. And as with the other cases, we only had the beginning inventory of 400 units at $90 each. And so we know that we're going to apply the $90 as the average cost for that first sale. That's the same under all three methods. And so that's going to be at 90 for a total of 27,000, just like the others. And our ending inventory is still going to be 100 units. That cost us 90 for a total of 9,000. Next, we're going to make another purchase. And in that purchase, we're purchasing, again, the 600 units for which the company paid $100. And so what we have to do is we have to recalculate the average cost, because now our average cost is going to consist of the 600 units that cost us $100 each for a total of 60,000. We're going to add to that what we had left in our inventory before, which was the 100 units at $90 for a total of 9,000. That gives us a total cost of goods available for sale at that point of $69,000. And we're going to divide that by the total of 700 units. And that's going to give us a weighted average unit cost of $98.57. Then when we make the next sale, that is the average cost that we're going to apply. And so the April 11th sale of 250 units we're going to apply this $98.57 unit cost to get cost of goods sold $24,643. We'll then take the ending inventory, which at this point is going to have 450 units in it. We're going to multiply that times the 98.57, and that's going to give us ending inventory of 44,357. We then make another sale. We haven't had any purchases in between, so our unit cost is still $98.57. And in this sale, we sold 400 units. We're going to multiply those by the $98.57 to get our cost of goods sold. And that's going to total $39,428. The ending inventory is then going to consist of 50 units remaining. We'll multiply by the $98.57, and that will give us ending inventory at that point of $4,929. Next, we buy some more inventory. So on the 15th, we buy 200 more units at $105. Plus we buy on the 18th another 700 units at $95. So what we need to do at this point is figure out our adjusted average cost. And so we need to consider all the things we had available. So we had this $4,929 available from our ending inventory on the 14th. Plus we had the 200 units at $105, which totals $21,000. And then we had the 700 units at $95, which totals $66,500. That means we had a total cost of what was available for sale at that point of 92,429. That was for a total number of units of 950. And if we divide the 92,429 by the 950, we get 97.29 as our new weighted average unit cost to apply to future sales. So then when we make this sale on April 21st, we sold 800 units. We multiply those by the 97.29 to get cost of goods sold. 77,832. Our ending inventory then, the remaining 150 units times the 97.29 gives us a total of 14,594. So this is our ending inventory for the end of April. To get cost of goods sold, again, we have to add up this individual sale costs of goods sold amounts. So we're going to add the $27,000 from the April 6th sale plus the $24,643 from the April 11th sale plus the $39,428 from the April 14th sale plus the $77,832 from the April 21st sale. If we add those together, we get total cost of goods sold of $168,903. Our sales is still the same as the other two methods. That doesn't change from method to method. So our $297,500 minus our total cost of goods sold of $168,903 gives us our gross profit of $128,597. So you can see that the gross profits under each of the three methods are not drastically different, but they are different, and they will be different typically when we're using these different costing methods. That concludes our demonstration of the perpetual inventory costing methods. Thank you for watching, and have a wonderful day.